Earlier this week, the stock market hit a 3-month high on the prospect of economic recovery, and at the same time, Bloomberg reported this week that only 1/3 of unemployment claims have been processed so far. So how did Wall Street rebound so fast?
Executive editor of the American Prospect, David Dayen, has a piece that explains exactly this, and he joins us now. Great to see you, David.
Good to see you guys.
Yeah, absolutely. So, I mean, this is one of the things that, it's kind of a hallmark of the dysfunction of our times. You have mass unemployment. You have 74%, I think, of the American public saying we're headed in the wrong direction. Millions being kicked off of health insurance, unable to make rent, chaos in the streets, and yet stock market's doing great. What's going on?
Well, it's really two words, and the two words are Federal Reserve. So if you actually dig in to the stock numbers and all the capital markets, really, not just stocks, you see that there was a deterioration in February and particularly in March, and everything ends on March 23rd, and there's this complete bounce back. Now, what happened on March 23rd? What was on that day that the Federal Reserve made an announcement that it would essentially do whatever it takes to prevent the investors from taking losses from the coronavirus crisis. That included the purchase of corporate debt, which had never done in its entire history. And just the signal of that, just the announcement that everybody would be protected, followed by the CARES Act, which gave the sort of muscle behind that announcement by giving $500 billion to Treasury that it could use as part of this money cannon of $4.5 trillion that the Fed had at its disposal. That all was enough. And everything really proceeded from there. Stocks went way back up. Corporate bond ETFs that track corporate bond markets went way back up. Every major corporation floated debt, and everything sort of went back to normal for the markets.
And David, could you compare that? What's the disparity between the markets and then the real-time economic conditions for actual working Americans?
Well, it's interesting that we're talking today because we just had this good jobs report of 2.5 million increase in jobs in May. However, that was coming off this incredible cratering in April, loss of over 20 million jobs. So, everybody's crowing here that we got back about 10% of what was lost. We're still seeing reports like a report from the Census Bureau that over almost half of all Americans lost income in the last couple months of this crisis. That shows up in the job statistics, but it's also just cuts to income from people who are working, whether they're getting furloughs or pay cuts or things like that. So there's incredible economic pain out there. It's masked a little bit by increased unemployment and these one-time stimulus checks, but that's all temporary. Yet the benefit to stocks and to investors is really permanent. And that's really the difference here. Congress could have given as much support to ordinary working people as they did to the investor class. But instead, we have this bifurcation. Everything that individuals got was time limited and temporary, and everything that investors got was endless and enduring.
Yeah.
David, did you see, we covered on the show this sort of big, ugly fight that broke out between two CNBC anchors. And basically, one of them was arguing, look, stock market's fine. It's going fine. It's going to continue to go fine. And the other one is arguing essentially like it can't be that disconnected from the reality of people's conditions. Like at some point, there is going to be some reflection in the markets of what a disaster economically we are facing for your average American citizen. How do you view that debate? Can it really be that wholly disconnected from the experience of the average American where there's just like no relationship whatsoever between the two?
Well, I mean, the first answer is that at some point when you have a situation like that, you're going to see social unrest. and what are we seeing right now? Not that the two are completely connected, but there is a case to be made that the pandemic and the economic collapse plays, is in the mix here. So that's number one. Number two, there are ways that this real economy struggle is going to be channeled into financial markets, the biggest being commercial real estate. I see an absolute collapse there in commercial real estate. And that's something that's traded as securities, commercial mortgage-backed securities. That will find its way into financial markets and cause some trouble. The real question is, can the Fed hold it? Because the Fed hasn't spent really any money here. They've done this all through the power of suggestion. And you can kind of get away with that for a while, but at some point the Fed is going to have to step up and show its hand. And if it's only solving for liquidity when the problem is insolvency, that is going to catch up with the markets at some point. So that will sort of remain to be seen over the summer. And if we don't get further relief from Congress, which this good jobs report is going to make more difficult, you're going to see problems in state and local spending. You're going to see more business bankruptcies, commercial real estate slipping. And those are all real economy things that could find their way into the capital markets.
So that's one thing I'm really concerned about, David. And as you rightfully said on the unemployment rate, which is that, we got back 10%, but we're still that's just in terms of what we got back from a slightly reopening. We don't know how many are still lost to the actual economic depression that we're in. Do you have any estimate for us on what that depression number looks like? I've seen everything in the 10 to 15% employment range. What do you think?
Right. I mean, right now we're at 13.3 according to these latest numbers. And there's this long note at the bottom of the jobs report that says that because of some mismeasurement, if people who are actually not working right now were measured correctly, that number would be at 16%. And that's from the Bureau of Labor Statistics. They further went on to say it would have been at 19% in April if that was all in place. What we're seeing right now is that some of these temporary layoffs have come back online as businesses have reopened over the last 4 weeks. And that's certainly good to see. The fact that only gets you about 10% at this point means that we have a long way to go. And the temporary layoffs that were transferred into permanent layoffs in the jobs report actually went up in May. So there is room to fall. And if state and local governments, which have lost 1.5 million jobs just in the last 2 months, don't get relief, you're going to see that number fall. And that could create a cascading effect. That's what we haven't seen yet, where bad jobs numbers lead to less revenue and less discretionary spending, leading to more layoffs. We haven't seen that yet. And if we do see that, then the economy can sort of fold in on itself. And that's my fear if there's no relief. I mean, the state of New Jersey has said if they don't get any help from the federal government, they're going to have to cut half the public workforce, 200,000 jobs. So, broaden that out to the rest of the country.
Thanks, David. Really appreciate your analysis.
All right. Thank you.
All right. We'll have more Rising for you after this.